It's 3:01. Welcome to the pension board meeting of February 24th. I call this meeting to order as a brand new chair. And is my microphone working? Can we hear it? Yeah. So I'm going to kind of fumble my way through this, so you guys bear with me as I'm going through the learning process here. First off, we have a call to order. Can we get a roll call?
Nick Curry.
Here.
Dan Jansen.
Here.
Christine Hoffman. Here. Greg Kleffner.
Here.
Eddie Vergara.
Here.
David Cohill.
Here.
John Patridge.
Here.
Matthew Grocke.
Here.
John Gutzstilla.
Here.
Jason Sharp.
Here.
George Candler. John Wiggins.
Here.
John McDaniel.
Here.
Lance Hewish. Debbie White.
Okay. If you'll look on your agenda, you'll see we have an oath of office. The oath has already been given to our newest member, Greg Kleffner. Greg, welcome aboard.
Thank you.
Appreciate you stepping up the plate and helping out our pension board and our city. So thank you. And you did have your oath of office, correct?
I did. Yes.
Any words of wisdom for us?
Not yet.
Okay.
Let me get through my first meeting.
There you go. We need to get an approval of minutes for the minutes of the joint quarterly pension board meeting held on November 18th, 2025.
So moved.
Can I get a second?
Second.
Got a first and a second. All in favor, say aye.
Aye.
Any opposed? Okay. There's no old business, new business. Consideration by general employees, police officers, firefighters, and board of trustees, consultants reports.
Good afternoon.
Hello.
Oh, yay. We have a quorum.
For the record, George Candler has joined us, so we have a quorum in the firefighters.
So I've got the quarterly book in front of you for the period ending 12/31. If we flip over to page number 4, sorry about that. You're good. Page number 4, I think you should have a loose leaf page tucked in. I'll kind of reference that in just a second. But before, on page 4, just a quick review. And again, this is the first quarter of our new fiscal year. And the markets really continued in positive fashion the way they had the prior few quarters. So if you look in the upper right-hand corner of page number 4, you'll notice all the bars are pointed to the right, meaning positive returns. The S&P 500 was up 2.7%. Those yellow or orange bars, which represent international, were up somewhere around 5%. And then the red or pink down at the bottom for fixed income were up, depending on the benchmark, about 1%. As you move down and look on the bottom right-hand corner, the 12 months that correlate to 2025, again, similar story. Very positive returns out of domestic stocks. The S&P was up about 17.9%. International was up in excess of 32%. And then fixed income was up somewhere 6 or 7%, again, depending on the benchmark. So 2025 was another very good year, really across most of the major asset classes. If I could now take a second and look at that loose leaf page or a couple pages that I tucked into the handout, just to give you a little bit more perspective on both the equity and bond markets. So the first page looks at the S&P 500 for the last 100 years. And what we do, this is a histogram of the last 100 calendar year performance measures for the S&P 500. So that second column from the right, there's a 15 on it. You'll see that the top number underneath that, 2025, we were at 17.88%, that very strong S&P 500 return. If you look at the column on the right that has the 38 on top of it, the two numbers at the top, 23 and 24, you can see we're at 26.29 and then 25.55. So this is now the third year in a row with very strong double-digit performance out of the S&P 500. Interesting point to kind of note, the average or annualized return of the S&P for the last 100 years is about 10.5%. But interestingly, only 7% of the time, or 7 times out of the last 100 years, has the return of the S&P in a single calendar year been within 2% plus or minus of the average. So the next time you're watching CNBC and some analyst is on there and they say, what do you think the S&P is going to do next year? And invariably they'll give you a number like 9, 10, 11%. The 93% probability that they're wrong, right? Usually, and how we get to the average of 9 or 10.5% is you pair a 25 or a 17 or a 30 with a -5, a -10, and some of those numbers in between. You blend them together and you get that average of 10.5. But very rarely do you actually get a return in 12 months that's close to 10.5. So again, just thought you'd find that interesting. If you flip over to the next page, it's the same kind of information, but now looking at the bond market. And now, not surprisingly, we kind of view the bond market as the lower risk asset class. And you'll see a lot less variability in this histogram. So 2025, our 7.3% rate of return is listed there in the third column from the right under the 17. So kind of smack dab in the middle, if you will, of the normal distribution of returns. Now, as compared to the equity markets, you only have a negative return, at least over the last 100 years, a negative return in fixed income 11% of the time. So a relative minority. And of that, the vast majority of those negative returns are just between 0 and -2.5%. So even when you have losses in fixed income, they tend to be pretty small. I have to point out, though, what we went through just a few years ago, 2022, was not only the worst year for the bond market in the last 100 years, it was the worst by a factor of 4. Again, the previous worst year was -292, and we were down over 13%. So significant, downside performance or struggle performance over that period. But again, things have certainly recovered nicely. So again, just wanted to give you a little bit more perspective on some of that historical information. With that, I'm going to jump back to the main quarterly book. Do you want me to page through the slides, or are we better just going on paper? Okay. There's a lot of supporting background information. I'm going to skip over most of that. If you touch on page 11, we often talk about interest rates. Obviously, the fixed income portion of our portfolio is quite sensitive. And so if you focus on the bottom right-hand corner of page number 11, what you'll notice is the most recent update to the Treasury yield curve. And the gray line is where we finished the year 12/31. And what I want to highlight there is on the left half of that graph, how much lower the gray line is compared to the red line where we were 3 months ago. And of course, the red line is below the blue and or the yellow line where we were 3 and 6 months before that. So you can see how interest rates over the last 9 months have really come down, in particular on the left-hand side of the graph. Now, the Fed had been cutting rates in the latter half of last year, which is a big part of that move. But the other thing that's interesting is way over on the right, if you look at the 20 and the 30-year plots, those rates have actually climbed slightly. So you've had a steepening of the curve at the long end. And then on the left-hand side, you have the left end, the short end of the curve coming down. So we are seeing a normalization of the yield curve. It's really been about 2.5 years where we've been talking about this yield curve being inverted or having almost this U shape, right? And very simply, the way I describe the yield curve, it's the way the bond market feels about the future. So if today is much higher than 2 or 3 or 4 years from now, it's kind of the bond market indicating that they don't think, the economic environment in a few years is going to be all that robust or all that great. So with that said, we haven't had a recession. We've had some pretty strong market returns, and now we have a normalizing yield curve. It's not quite there yet, but it is moving in that direction. So again, the bond market is beginning to kind of signal they think it's a little more normal, a little more traditional in shape, and more positive in the future. So again, still some work to do, but headed in the right direction. If there aren't any questions on kind of, again, the big macro environment, let's start to talk about the plan. If you go to page number 14, always make sure to touch on this page, the history of your plan going back to 1987, when you had $11.8 million in the trust fund. So again, as a reminder, the blue line represents our actual market value. So that $11.8 million has grown to $140.15 million as of 12/31. The red line represents the hypothetical, feeless return or feeless of the assumed rate of return. So if you each year had you just earned the assumed rate of return of the plan, you'd have $117.9 million. So you've outperformed your assumed rate of return collectively to the tune of about $22, $23 million. The other thing we like to point out on this graph are those kind of blue or gray bars down along the bottom. That represents your net cash flow. And so you can see in roughly 2009, we kind of crossed over the zero line, meaning the net cash flow is negative. And so all of that $11.8 million that you had in 1987 has been paid out of the system. And then since that time, you've paid an additional $39.3 million out, more than you've brought in contributions. But again, all the while, we've continued to grow that top line or that blue line asset up to that 140.15. And really just sort of graphically, this is the sweet spot of pension investing. You build up a nest egg that's able to grow at a rate that is faster than it has to pay out those benefit payments and cash flows. And so, there are a lot of pension funds that are still earlier in their life where they're somewhere in here, they're still growing, or they're on a cash positive basis. They're putting in more than they're taking out. But eventually, you'd expect them to look something like yours, where again, you built up that nest egg and it's growing at a rate to cover all those cash flows. The next few pages get into the asset allocation of the plan. If you go to page 17, I think that's the easiest way to see the allocation relative to our investment policy. And what you'll notice, we're fractionally underweight to domestic equity, over a little bit to international. It's just fractionally under to domestic. Global fixed is right in line, and then we are a bit underweight in real estate. Part of that is the drawdown from JP Morgan. Part of that is relative performance, and also we've made the decision to hire Stockbridge, so that we've made a commitment there, and as that kind of gets in and ultimately gets called, that will help kind of bring that back up toward the proper balance. But in the grand scheme of things are looking very good in terms of the relative allocation. Just to give you a quick update, mentioned the assets as of December were $140.15 million. As of this morning, the assets were $141.9 million, which is an increase of about 2.5%. So the period, early 2026, we're again positive, roughly 2.5%. So, and when we flip ahead a couple of pages, you can see what that's going to do to our fiscal year period. So page 21 brings all of this together. So again, the macro environment was positive. We earned 1.8% gross of fees relative to the policy of 2.06. So we're a little bit behind the policy return, and we placed in the 60th percentile. For the 1 year period, 2025, we were at 12.18, a nice rate of return for 12 months, but that was behind the policy of 14.49, and we placed in the 85th percentile. Really, two big reasons for that. We've been talking about them for a period. One was some of the underperformance in the growth portfolio was certainly an impact. Obviously, we took some action earlier in the year to address that. But then the other one is down at the bottom of page 21, the Eaton Vance small and mid-cap portfolio. You can see both for the quarter, negative 67 basis points versus a positive 2.2. And for the year, negative 5.6 versus a positive 11.9. We did talk about that somewhat last time. And it is essentially the trend that was in place has continued. It has been a very difficult period for small and mid-cap managers that buy companies that make money. As silly as that sounds, if you look at it from a broader term perspective, companies that earn money, that make money, tend to outperform companies that lose money 4 to 1. That makes sense, right? If you lose money continually, you're not really in business for long periods of time. So generally speaking, the earners outperform non-earners 4-1. For the last 9 or 12 months, negative earning companies or companies losing money have outperformed companies that make money 8-1. It's been just completely reversed, in particular in small cap. Yeah. Some of it, I think some of it is small cap companies tend to be more interest rate sensitive. And so as you kind of left, the Liberation Day part early in the year, there was a lot more euphoria. The market started to be more optimistic about interest rate cuts. And so if you were a small cap company that was really struggling, you had a lot of debt on your balance sheet, all of the euphoria about upcoming Fed cuts is a bit of a lifeline. And so, we thought maybe you were going out of business in March, but now with these potential cuts, all of a sudden maybe, and so you saw this kind of jump in junk, right, or lower quality, and that is certainly playing a part. And so all that to say, it's certainly disappointing to see these kind of performance numbers out of Eaton Vance, and you don't see this here, but a number of their peers are a very similar story, really, really struggling in terms of relative performance. But I've had additional conversations with our research analyst that kind of covers this space. I was actually with Eaton Vance just Wednesday of last week, and they talked about their portfolio being like this is a 4 standard deviation event in terms of how cheap and how much their earning stocks have underperformed the rest of the market. And sort of they're saying it is just an incredible sort of opportunity, and it echoes like our analysts at this point, like they see this as a huge buy, huge opportunity. Like these are very inexpensive stocks, and they would not expect this to continue. But with that said, it's difficult when you sit here and look at the report and say, "Oh my gosh, they are so far under for the last 12 months." It's painful. But just wanted to give you a sense that it's not like something is broken in their process or all of a sudden they're doing something very different. The quality earning companies they buy are just being ignored completely by the market. And we hope that is a short-term phenomenon, because if that continues for an extended period, then you start to have that bubble conversation, right? If companies that don't make money drive the market for 2, 3, 4 years, that becomes truly unsustainable. So again, just wanted to provide a little bit of context to what you see in that large underperformance, which really accounts for the entire total fund underperformance for the year. If we flip over to page 22, now to really contrast that, we look at our newest portfolio, DFA International Value. So they were 8.4% for the quarter versus 5.2%. And look at the year, 45.2% versus 40.6%. So not only did they outperform very nicely, but that was by far the best performing asset within the plan. Keep in mind that we took those funds from Euro Pacific Growth and WCM. So over the last 12 months, those funds earned 29% and 21%. So a lot of outperformance by taking those dollars, diversifying into that DFA fund. So that has paid off quite nicely. WCM, very volatile manager. We've seen that for over time. Now, over the longer periods, they perform extraordinarily well, but they have been hurt somewhat similarly the way Eaton Vance has. So you see big underperformance in the quarter. Not quite as bad for the year. But certainly a relative underperformer. The good news is that's a relatively small allocation, so it has less of an impact. As we move down, we get into fixed income, and our fixed income has done quite nicely. So we've got Baird short term, right in line with the index, and then Sawgrass 1.1 versus 96, and for the year 8.5% versus their benchmark of 7. So again, relative to some of those equity returns, those aren't huge numbers. But for fixed income, in a portfolio that's generating, call it 4.5% to 5% income, for us to finish the year with an 8.5% rate of return is quite a nice return out of fixed income. And then last couple of pieces, we have PIMCO Diversified. That fund continues to do really well. 2.3 versus 0.35, and for the year 10.5 versus 8.4. Again, there's an international component. That's a diversified portfolio, non-U.S. So some of for the same reasons that international had a really good year, also helped the returns of the PIMCO portfolio. And so far here in 2026, we're continuing to see that international doing really well compared to the domestic market. Big part of that is the dollar falling in value. You know, if you went to kind of the end of 2024 and look backwards, we really had 10 years of dollar strength, really hurt international returns to the point where I actually had a number of clients say, you know, we've been international for a long time. The return's been half of the domestic market. Should we just get rid of international and put it all in the U.S.? Invariably, you know, 2025 happens and all of a sudden international doubles that of the U.S. market. So glad they didn't do anything, but it's interesting to kind of see that dynamic. Then the last piece of the portfolio, again, we mentioned JP Morgan, 135 versus 107, and for the year, 4.8 versus 3.8. So again, not huge performance out of real estate, but now positive. We're really on about 6 quarters of positive performance. And if you talk to those managers, what you tend to see is they feel like, you know, things are pretty stable. You're kind of getting income right now. That's most of the return at 4.5-5%. And for the next, 18 months, starting to get some incremental appreciation on top of that income. So, expecting or hoping somewhere in that kind of 7 to 8% kind of return for, say, the next 12 or 24 months. So again, looking better. Where again for the last couple of years that was the negative in the portfolio as they were facing the drawdowns. But again, generally speaking, overall, still a very positive environment. Again, I mentioned in the 6 or so weeks since the end of the quarter, we're up roughly 2.5%. So that puts us, in the neighborhood of, 4.5% or so on the fiscal year. Obviously, a long way to go, but certainly things seem to be kind of moving along in reasonable direction. So let me pause there, see if anybody has questions, comments on anything that I've covered, anything that I've skipped over.
On the Eaton Vance, did you say, is it your analyst team that sees them as a buy, or was it Eaton Vance's own people?
Well, it's sort of both. So when I was with them, they were sort of demonstrating from a valuation perspective and like a valuation spread, the price of their securities compared to like large cap. That was sort of the 4 standard deviation. Like their portfolio is incredibly cheap compared to normal, right? And then separately, just when talking to our analyst team about not only their portfolio, but also some of their other peers that we are covering, it's the same sort of message as these portfolios, I think, are very strong fundamentally, and we expect them to do very well. But for the last, 6, 9, 12 months, the market just hasn't cared. But we think that is a relatively short-term phenomenon where, again, typically, as I mentioned before, if you just strip it down to just earners versus non-earners, earning companies, and that's what Eaton Vance is. It's quality earning companies. They tend to outperform 4-1 versus companies that lose money. But in this last period, the companies that have lost money are out earning 8-1 as compared to the earners. So kind of both. The only other thing that's kind of listed on the agenda, we talk about potential for rebalancing. Sorry.
No, go ahead for a minute.
Okay. If you go back to page 17, as of the end of the quarter, we were relatively in line, only in total about 1% over our equity target. And, with the most recent kind of price adjustments, we're still right about in that same ballpark, over by roughly 1.25% on a total fund basis. So there's no need to rebalance. Greg, just for your benefit, we have a hard cap in the ordinance, so we can't let the equity exposure run too far. So we always want to make sure we're aware of that situation in particular when equities are running. But we have room from that cap. The other thing that I would highlight too is with the commitment to real estate, as that money gets called in, or as, they ask for those funds, barring you providing any other instructions, the way we would handle it is let's just say they called $1 million, right? We would look to the portfolio and strip it from any overweights to help bring it back, as opposed to if I took it from elsewhere in the portfolio, then any overweights would become larger, and then at your next meeting, then we'd be that much closer to our cap, and we'd have to take some action. So just as a general, understanding, we would kind of pull it from the overweights to help keep us rebalanced or in line.
Just a question. So the ordinance controls the asset classes, basically. Is that?
There's a hard cap on our equity exposure. via
Equity
the
only, or
ordinance.
does it also say this much fixed income?
It,
this
it
much
really
real
does
estate?
not. The primary is equity exposure is
Okay.
capped. Now that is not a legal requirement. Like that's not a
Mhm.
state or any.
Well, the ordinance could change.
But the ordinance can further restrict,
Right.
And that's what our ordinance does. Is it does provide that hard cap.
Have we ever considered alternative investments, which seem to be getting, private equity, things like that?
We definitely have, and actually we had a little bit of a presentation / educational just last quarter on private equity, but there's limitations. Again, the ordinance doesn't prohibit us from doing it, but like private equity would count against the
It would be
equity number. And there has been some conversation in previous years where the city is maybe not in favor of some of those alternatives. So that is also something to keep in mind. But as of right now, the ordinance does not prohibit those.
Okay.
Yeah, we've had discussions, but it's but nothing has really moved forward outside of the real estate.
Okay.
Didn't we vote to carve off? It's in our investment policy statement now that we can have alternatives up to 5%.
Correct.
We did.
Correct.
We just voted on that, I believe, last year.
Yes.
Yes.
At the big meeting.
So to that point, we did sort of within the investment policy, sort of carved a holding area or a bucket, but there's nothing targeted. But we did kind of create a space within the policy to potentially house, some.
You're right.
some
If we did private equity, then we'd have to reduce the equity.
correct.
But there's also like commodities and other things that you could potentially do too.
Certainly. Yeah.
Okay.
But that was really everything that I wanted to bring to your attention today. Again, kind of the 10,000 foot view. Generally consider continuous strong performance, things moving in the right direction, and hopefully, whether it be the Supreme Court getting involved with this tariff discussion, it doesn't unsettle the markets too much, and we can kind of continue on this positive direction.
Very good. For the record, welcome Lance Hewish. He's joined us now. And we need to approve Brendan's investment consultant quarterly investment performance report. We can start with the general board.
So moved.
Second.
Got a first and a second. Roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Huffman,
Yes.
Greg Kleffner,
Yes.
Eddie Vergara.
Yes. Please.
Second.
Got a motion and a second. Roll call.
David Cohill,
Yes.
John Patrick,
Yes.
Matthew Grocki,
Yes.
John Gutzstella,
Yes.
Jason Sharp.
And the firefighters.
Motion. Second.
First and a second. Madam Clerk, roll call.
George Cantler,
Yes.
John Wiggins,
Yes.
John McDaniel,
Yes.
Lance Hewish.
All right. Next up, we have a possible action. Brandon, do you want to talk about this?
It's just a placeholder.
Oh, it's a placeholder in case we needed it. Yeah.
Yeah, that's kind of what I covered too, just sort of referencing the allocation and everything.
Okay. All right. Pension administrators report. Dustin.
Sir, thank you.
Yep.
Very good. Quite a few things on the pension administrator's report this time. I'll jump right into it here. In between the meetings, there was a question from one of the board members about possible ethics training, and I know since I've been here, we hadn't done that on the board, so I did inquire with the pension attorney and the city attorney about what the requirements, if there were any requirements on the board for ethics training, and two, what would be available. And Pedro, our pension attorney, I think he's on the call here and listening in. He said there are, unlike the city council where there are some required ethics training, there are no requirements on board members, but he did provide some links, which I provided here in the pension administrator's report, to the state trainings that are available. And then I also spoke with the city attorney and found that he had been doing some shorter trainings with some of the other boards at the city. So he is been kind enough to schedule to come at our August meeting, since our May meeting is our big one with, financial reports, budgets, and many other things. So he's going to come to the August meeting and do a 15 to 20 minute ethics training for the boards. Moving on, our credited service purchases. So as a recap, since we do have a new member here, back in October, the City Council passed an ordinance to allow for the General Employees Board pension plan to allow employees to purchase up to 3 years of credited service, providing that they met certain requirements, such as former military service or prior service in some sort of municipal, state, or federal employment, of which they were not entitled to receive a pension. So after that, at our last board meeting, we adopted some forms and rules and guidelines for how to make this process happen. So after we did that, I asked the pension attorney, since we have adopted this in the ordinance and we have a procedure for it, do we need to have these approved each time that it happens in the way that we approve retirements, or is this now an administrative function? And Pedro said that basically this is now, since we have formally adopted this process, that it's just an administrative function, and that I can just advise you guys of where we're at in this process, how many people are doing it, and some other things. There are some, we'll see later, there's some invoices as well that are tied to this, because the pension board pays for and we expected at the beginning in this first 6 months, when it's opened up to all employees, that there were going to be some initial costs with the calculations of these from the actuaries, but after that there won't be near as many, because it would just be the new hires that have the opportunity.
Just out of curiosity,
Yes.
Are those pre-tax dollars for the people that do that? Or?
Yes, they are pre-tax dollars.
Okay, thank you.
14 members have submitted applications. We have 2 members that have completed their purchase through lump sum payment, and then another 5 members that have elected to an option of some form of either 2, 3, 4, or 5 year payment plans over the deductions through payroll to make those credited service purchases. That does not mean that those that haven't made that option, they still have that option available to them. Which is actually something I need to get clarification from Pedro on, because as I've been doing this, I realized in the ordinance we seem to give them 6 months to apply, but there is no timeline for them to make a decision on whether they want to do this or not. So I do need to get some sort of clarity. We may need to adopt a rule at our next meeting or something like that, because you don't want someone who applied in the first 6 months come back 5 years later and saying, now I want to do it. So that doesn't seem right. So we'll get some clarity with him on that.
In general, how much are those?
It's completely dependent upon each employee's individual situation. I've seen from someone purchasing 2 years that's early on in their career, and it was, I think, 11,000, up to someone who was right near the end of their career and a relatively high earner would be 116,000.
Oh, okay.
So there's a large span in there. We did receive a letter from the Department of Management Services directly to the police board. I provided that letter here. They did approve all the actuarial evaluations. They accepted those. They did recommend that the board consider lowering the current 7.5% investment rate of return. They gave some recommendations in there, but I think our actuaries had already talked about that at our last May meeting, and I haven't talked with Brad Armstrong in a bit, but I'm sure at our May meeting that's probably going to come up. I'm not sure that it would be to the level of what the state recommended here. I think most likely not. But I think the state has a different view than what the actuaries are seeing.
What
So-
did the state recommend?
What's that?
What did the state recommend?
It is right there on a couple pages over. They recommended somewhere between 5.6 to 6.2%.
Holy cow.
Yeah, that's I don't really understand it myself, especially when you can look at the plan and see that it's returned.
It's done better than the 7.5.
Right, it's outperformed the 7.5 over the life of our
I
plan.
mean, 7.5's a little on the high side probably for plans. I mean, it's just less conservative. So.
Right.
And the state, the state plan is assuming a lot more than that. I mean, I think they're 6.55 or something. So with their own plan, they're doing more than they're suggesting.
Well, it also depends on what their mix of investments is too. So
And funded status, and there's so many
Yes.
things that go into it. Yeah.
interesting.
Next meeting, I'll be bringing the budget. If there is anything that you guys think that I should increase from prior year's budget, please let me know in between now and then if you want to take some time to review last year's budget. But the only thing I'm really seeing that I'm definitely planning on increasing is some extra actuarial calculations. There always seem to be something every year that we didn't necessarily plan for, whether it's adjustments for mortality tables or impact statements, or now these calculations for the accredited service purchase. So whenever I have something that is not been budgeted for is when I bring it in an invoice. If it's something we plan for, we just, use that as an administrative process and pay the invoices. But it's when it's something that was not budgeted for and we didn't plan for, then I bring these separate invoices to the boards for approval.
And that's why I've got you there, because I don't see anything that would fall in line. And it's probably just an aging thing for me because I'm getting super old. Can you recap whether or not we've addressed the renewal process for annually for the pension? In other words, so that somebody who dies off is not continually getting paid.
Oh, yes. So we have two things going on. We've done the annual letters now that I'm sending out in May of each year, the proof of life forms. And so I'm sending those out. And we have the new software, which has been much better.
So they can do this online.
So death audit software. So I'm doing that online, but it's not them doing it online. It's like I upload all the information of our retirement population, and this one actually works much better because in the previous software I had to upload all of the information each time. This time they have a login and they have a database of our people, and I just receive a report each week saying, hey, we've got so-and-so passed away. So far, each time, since we got the new software, we have already known about it before the software flagged it, but the software has been flagging it pretty quick. But generally, unless it's someone who didn't have much of a connection here and moved off and retired somewhere else, Generally, we hear about any retirees passing pretty quickly. But so yeah,
Are the proof of life letters notarized, or they have to send them to
they
you?
do. So there's two options. One is to either have it notarized, which is what most people do, because frankly, most of them still live around this area. They come into the city. We have notaries here, and they do it that way. There's a form that I send out also with it. I send out two forms. One has a spot for two witnesses to sign as well, and it can't be a family member. So, because we do have some members that are immobile, and getting a notary to that person, or is problematic. So that's why we provide that option of two witnesses as well.
Thank you.
Continuing education, the next FABA conference is actually the annual conference, June 29th to July 1st at the Renaissance Orlando. Please let me know if you're interested. I already got 2 names down that are interested in going. And then upcoming elections, congratulations again to Mr. Kleffner. Welcome aboard. And today we have both of our 5th member selections from our police and fire board making their selections. So Mr. Gostilla has indicated that he would like to continue on as the police board if the board sees fit. And the other position is for what was Debbie White's position, and we know that we haven't seen her in several meetings, and there's some extenuating circumstances with that, so probably expect that position to be filled with someone else, especially since we didn't receive any confirmation from her or anything that she would want to continue. So that's coming up here pretty shortly in the agenda. Next quarterly meeting, May 26th. Like I said, it's the large meeting, so that one starts at 2 o'clock instead of 3 o'clock, so that we generally get done by 5, so not pushing anyone over time that they need to get out or anything. Any questions for me?
On the years of service buyback,
Mhm.
the formula for that, is employees just reach out to you as a recommendation?
Yes, so I mean, I don't have the formula either. It is an actuarial calculation that's done by the actuary. That's what we're paying for in these invoices. It's rather complex. It has to do with how much they're earning, how much, what age they are, what their actual scenario is going to be. Because for some people, buying 3 years of service doesn't mean they get to retire any earlier. It just means that they have 3 extra years of service. So they'll still hit their age before they reach 30 years of service. But for some people, when they buy 3 years of service, it may mean that they reach 30 years of service before they now reach their age. So they would actually start receiving a pension check earlier, which means it's going to cost them a lot more to make that purchase. So,
If they're on the old plan, they can retire regardless of age with 30 years service.
yes, yeah. But still, it would cost more if they're retiring 3 years earlier than they otherwise would have, because they would be receiving a pension presumably 3 years longer.
I'm just saying it's fairly new. We have a lot of former military.
Yeah.
And that question's been asked a lot.
Yeah. They have until April 20th to make their application, because it was passed on October 20th. So, all right.
That's all from you?
That's all for me.
Any other questions? All right, moving on to consideration by General Employees Board of Trustees. We need to approve the summary plan description for General Employees Retirement System as provided by Sugarman, Susskind, Braswell, and Hera. Can I get a motion?
So moved.
Second. Discussion or question?
Sure.
Austin, on page, hold on, go back page number. Just on the 3rd page of that. Option 1, 10-year certain in life, the retirees paid a pension benefit for life. Everyone else, where they have an where they're not taking the regular pension, it says reduced. That one doesn't say reduced, but I assume it is.
I'm sorry, I didn't quite follow all that. I
So
missed it.
option one, so you basically your benefit options.
I'm trying to figure out where you. Oh, okay. Option one. Oh, five. Okay.
Okay, yeah.
Yes, sir.
So 10-year certain in life, isn't that also reduced benefit?
For
Number one.
yes,
All
for
the others say reduced.
yeah,
That one doesn't say reduced.
it is reduced. It is a slight reduction, generally less than 2%, but yes, it is. It is a reduction.
You just might want to say reduced since it's.
Agreed, sir. I think we can add that in as a Scribner's error on that.
That we could do.
Totally noted. Motion on that.
We take the motion in a second, now we're doing discussion. So if there's no more discussion, we can call for the vote.
Do we need to make a motion on that Scrivener's there?
And you don't need to make a motion on the scripters, you know.
Okay. All right. All right, let's move for a vote. We got a first and a second. Let's move for a vote.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Greg Kleffner,
Yes.
Eddie Vergara.
Yes.
All right, it's approved. It's approved GRS consulting, Brad Armstrong, payment of invoice number 498208 to GRS Consulting in the amount of $4,300.
So moved.
Second,
Got a first and a second, madam. Any discussion?
discussed and explained what that was about.
I was just going to, point out some details of how that was for 7 calculations at $575 per person, and then one person decided to change their calculation from 3 years to 2 years to make it a little less costly for them, and so that's a revision in there as well, which got us to the $4,300.
Any discussion? Madam Clerk, roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Greg Kleffner,
Yes.
Eddie Vergara.
Yes.
All right, we'll move to, I don't move. Let's approve GRS Consulting Brad Armstrong payment of invoice number 497577 to Gabriel Roeder Smith and Company in the amount of $3,300. Dustin?
Yes, so this is for the actuarial impact statement for both the credit service purchase and the changing of the cap from 100,000 to 110, then 111, 112 over the 3-year period. Not much more to say about it than that, I don't think.
Move to approve.
Second,
Got a first and a second. Any questions, comments? Madam Clerk, roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
yes.
Greg Kleffner,
Yes.
Eddie Vergara.
Yes.
All right, next up, we approve the application for retirement. Tammy Leonard, Operations Administrator, Beaches Energy, effective March 1st, 2023. Separation date, February 27th, 2026. Meets age service requirements for backdrop retirement, 33 years and 3 months of service.
So moved.
Second.
Just discussion, why do we, I heard you say it before, but why do we approve retirements? It would seem like that would be
I think it's
administrative
more
too.
just a cursory and gives the board an opportunity to thank people for service in this
Okay,
situation
yeah,
like
'cause
this, reaches
In
33
theory,
years
we
of service.
can't not approve them. if
Right.
That's right. Yeah.
Correct.
Sometimes
much.
we make a fuss about it, though. Nice to have that on the record.
All right, we got a motion and a second. And any other comments, questions? Madam Clerk, roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Greg Kleffner,
Yes,
Eddie Vergara.
Yes.
All right, next up, consideration by Police Officers Board of Trustees to approve the summary plan description for police officers' retirement system as provided by Sherman, Susquehanna, Braswell, and Hara.
so moved.
Second.
Got a first and a second. Questions or comments? Madam Clerk, roll call.
David Cohill,
Yes,
John Patrick,
Yes.
Matthew Grocke,
Yes.
John Godzilla,
Yes.
Jason Sharp.
Yes.
All right, next up, select fifth member of the City of Jacksonville Beach Police Officers Retirement System Board of Trustees for a 2-year term commencing on April 1st, 2026, and expiring on March 31st, 2028. The fifth member is currently John Gustilla. Got it. Okay. Term expires on 3/31/2026.
Make a motion to nominate John Gostilla to continue to serve as fifth member for the police board.
All right. We got a nomination for John Gustilla. Any other nominations?
Second.
All right. I'll take that as a first and a second. Questions, comments? Madam Clerk, roll call.
David Cohill.
Yes.
John Patridge.
Yes.
Matthew Grocke. John Gustilla.
Yes.
Jason Sharp.
Yes.
Congratulations, John. You passed go. You don't get $200 there. We're going to approve the GRS Consulting Brad Armstrong payment of invoice number 497572 to Gabriel Roeder Smith and Company in the amount of $3,300. Dustin, any comments?
Same thing. This was for the calculation of the raise of the cap from 100,000 to 110, then 11, then 12. Yeah, I think that's about it. Any questions on that?
And the backdrop too.
And the backdrop, yes, and the backdrop, the raising of the backdrop from 3% to 3.5%, yes, as well.
So moved.
All right, we have a first and a second. Questions, comments? Madam Clerk, roll call.
David Cohill.
Yes.
John Patridge.
Yes.
Matthew Grocke.
Yes.
John Gustilla.
Yes.
Jason Sharp.
Moving on to consideration by firefighters board of trustees. We're going to approve the summary plan description for firefighters retirement system as provided by Sugarman, Suskin, Braswell, and Hera. Going to get a motion.
Second.
Got a motion and a second. Any questions or comments? Madam Clerk, roll call.
George Cantler.
Yes.
John Wiggins.
Yes.
John McDaniel.
Yes.
Lance Hewish.
All right, and then let's select the fifth member of the City of Jacksonville Beach Firefighters Retirement System Board of Trustees for a 2-year term commencing on April 1st, 2026, expiring on March 31st, 2028. Fifth member is currently Deborah White. Term expires on March 31st, 2026. Dustin?
Yes, sir. Thank you. We did have 3 applicants that have applied here. Mr. Adam Petrus, David Weisblatt, and Steve Shadow. All their applications are provided here. All members have been interviewed by the City Council. Did you reach out to Mr. Petrus at all? No. The city clerk did reach out to Mr. Petrus within the last couple weeks and didn't receive confirmation back that he's still interested. But though I will say that he did seem very interested before, and is a very qualified candidate as well. And other than that, most of you know Mr. Shadow, and he's here today. So of these, this is the fifth member is to be selected by the other members of the fire board. So this is completely up to the 4 of you.
So one of y'all can give a nomination.
Second.
Any other nominations? All right, Madam Clerk, roll call.
George Candler.
Yes.
John Wiggins.
Yes.
John McDaniel.
Yep.
Lance Hewish.
Motion approved. Congratulations, Steve. You are now a member. But you don't get a microphone, okay? Right. Any other items for discussion today? Seeing none, I don't have any courtesy of the floor. So let's move for adjournment.
So moved.
Second.
Got a first and a second. Meeting is adjourned.